At the start of 2023, the multifamily sector's supply continued to outpace the demand for the sixth quarter in a row. Over the past 12 months, Midwest and Northeast markets fared the best, with year-over-year rent growth only slightly down. The downward movement of rents will continue for the rest of 23 as the risk of recession hangs over the economy and many markets are experiencing oversupply conditions. When demand in the multifamily market spiked in the first year of the pandemic, developers accelerated plans for new projects. Now, 2 years later, a good number of those developments are set to deliver this year, the most new supply to hit the market since the 1980s. Comparison to units under construction pre-Great Recession are not analogous to a significant change in the multifamily properties being built today. Today, mid and high-rise buildings remain the majority of new developments, and these types of buildings require double to triple the construction time compared to garden-style properties. Thus, while the number of units under construction looks noticeably elevated, the delivery of units is spread out over a range from 1 to 3 years. For example, some high-rise projects under construction won't deliver until 2025. In addition, 20 markets are projected to hit new record deliveries in 2023, with 12 of those markets being Sunbelt locations. Austin, in particular, expects 18,000 new units to be delivered this year, more units than Atlanta, despite having half the inventory. These record deliveries, combined with weak demand, put a number of these 20 markets at serious risk of worsening fundamentals by the end of the year. However, the rising interest rate environment, combined with the pullback in construction lending, has some developers unable to move forward on proposed projects. With fewer projects moving forward, we could begin to feel a meaningful pause in deliveries towards the end of 24 and into 25. At the end of the first quarter, top 4 rent growth leaders were Indianapolis, Cincinnati, Columbus, St. Louis, and while Phoenix and Las Vegas were at the bottom of the pack with year-over-year rents at negative 1.9%. CoStar projects the national year-over-year rent growth will moderate further over the next 12 months from 3.7 to 1.8%. The majority of markets poised for the strongest rent growth this year are in the Midwest. Multifamily was the darling asset class for investors in the past 2 years, but the tailwinds have become headwinds for investors and owners. 3 things are no longer working in favor of investors: a rise in interest rates, historical record of supply in the pipeline, and rent growth deceleration. An unprecedented wave of loan maturities is also coming over the next 3 years, and maturities will peak in 24 with a record high of $254 billion. Rates are now hovering around 7.5%, which, depending on loan to value, is on average about 300 basis points higher than most borrowers' current rates. Many owners who have faced or enjoyed cheap capital at excellent terms will have to decide to refinance at higher rates, put in more equity, or sell their properties, or even give their properties back to the bank if it's just a non-starter. Despite the challenges, there is still an abundance of interest in multifamily assets. Sellers evaluated their initial asking price, the reserve price, and are willing to flex downward 41% more in their pricing on auction day compared to quarter 1 22. This indicates that sellers are beginning to adjust their pricing expectations to meet current market conditions, i.e. interest rates, and buyers are looking for opportunities and sense a shift in the market. The multifamily market is at a crossroads, and now is a great time for brokers to reset their clients with new pricing expectations. Now, if you're in need of an experienced commercial real estate broker, I can be reached at 281-222-0433. I appreciate your time and have a good day.